on Money Matters with Matt and Rich, episode
11.
11.
Already at 11.
Yep.
So like Rich said, we got a special guest coming in next week. He's got a different perspective, I guess you could say, on building wealth. And I think it's going to be very, very valuable, right? Because it's stuff that stuff we didn't know about, and we've been chatting with it, and it's like, all right, this is actually kind of cool.
Yeah.
Like, this could be a different, way to just enhance your portfolio and just spread things out, right? You don't want all your eggs in one basket.
Yep. He works at Top Wealth Agenda out of Florida. And again, Bank on Yourself Advisor. Definitely go look him up. Check him out. He's got some podcasts out there. He's got some videos. So Mark Bashirs.
Yes.
Next week via Zoom, which I'm sure we'll have all that squared away.
Yep.
That'll be good.
Yes, it'll be great. So today we're going to talk about why you should not waste your money on your down payment.
Don't waste it putting more money down.
Yeah, it's not always the best route for you to go.
No.
Okay, and I know that may sound crazy because everyone says, your loan amount should be as small as possible, which in theory sounds correct.
Won't I get a lower monthly payment? Because
Right.
all we care about, not all we care about, but the majority of what we want.
A big decision maker on it.
How much is that monthly payment?
Right.
So how do you get a lower monthly payment, or how do you get that monthly payment to be right? Oh, I put more money down.
Right.
Well,
May not always be the case. And actually, in 95% of cases, it's not the case to put more money down. I know that may sound wild, but there's other options for you, which is why it's not the case. Right?
and let's be clear that it's just about, there's not so if they have to put more money down because of some other, debt to income factors or whatever the case may be, then yes, you might have to you should put more money down. However, if we're just talking about getting a lower monthly payment,
Correct.
then no, don't put more money down.
Right. If you're okay with spending $300,000, $500,000, like the examples we're going to go over, right, on that piece of property, and you just want the lowest monthly number and you have a set number, putting an extra $10,000 down, $5,000 down is not going to impact the payment like you think.
Yep.
But one way that can is buying down the interest rate.
Yep.
So-
and that's the strategies that an agent and a lender will be able to, working with the right agent, the right lender will be able to provide you, because we're not just order takers,
Right.
Like, hey, I get it, but let's plan this out better for you.
Right.
Here are some different strategies. Just like during COVID, when buyers agents had to become more strategy minded to get offers accepted than ever in the past, right? Like, if you didn't have the right strategies early going in, you were
fell
just
behind.
you're just an order taker. You're putting in an offer, it's not getting accepted, you move on to the next one. Like, were strategies. So this is a strategy to help buyers reduce their monthly payment.
Correct.
And possibly even get that covered by the seller.
Yes.
If not, no big deal, but there's the possibility that
Right.
the seller even covers that.
Right. So to break it down, buying down your interest rate, this is also referred to as buying down points. I think a lot of people have probably heard that, or mortgage points. It's all the same thing, right? So what it is 1 point is 1% of your loan amount. So that's different for everyone. So when your cousin's neighbor's dad says that, back in 1997, he, his 2 points was $2,000, you shouldn't be paying $8,000. So, it's all relative. So just note that.
The price of the home was much lower.
But 1 point is 1%. And generally speaking, that buys your rate down about 1/4 point to 1/2 point, depending on the market, depending on just honestly, even the sales price can kind of depend on that, whether it's a jumbo loan, a conforming loan, even FHA loans are different. So generally speaking, 1/4 point to 1/2 point on the interest rate for one buy down point. Okay, so I know there's a lot of math there.
Yep. So 1/4 point.
So you go from a 6 to a 5.5 by paying 1 point. You could hypothetically, or you go 6 to 5.75. That's essentially what I'm meaning by that situation. So I actually got 2 examples here.
Perfect.
Actually, as of 11 o'clock this morning, because I wanted to make it as accurate as possible.
Great.
Pricing out 2 different scenarios.
Great.
So,
and these price points are the buyers that, in this New Hampshire market that were probably going to be the most common buyers, price points.
Yep.
Again, it could be anywhere above, in between,
below. It's just these are general scenarios for what you'll see, especially southern New Hampshire S type.
and the average price point for a home, in New Hampshire is about 400,000. So we went low and then we went high.
Yep.
So you can kind of see the difference.
Yep. And I think it's going to be kind of funny seeing the difference in payment difference between the two of them. So first one, $300,000 purchase. I did 5% down because, again, that's kind of a general, maybe you don't have a house to sell. Maybe you're a first-time buyer. 5% down.
Which is what, 15
grand down. So you're at a 285 loan amount. I assumed a 720 credit score just to kind of keep it flat. And then I also assumed a 30-day rate lock. The rate lock doesn't affect the amount of points you can buy down, but just to keep it all consistent. That way we're not playing with two different scenarios.
Yep.
The par rate at that was 6.475. Right?
Oh, 6.5.
Almost 6.5.
God, how far we've gone.
In 6 months. But the principal, interest, and mortgage insurance payment on that was $1,882.
So principal, interest, mortgage, insurance. That doesn't take into consideration taxes and homeowners insurance.
Correct. Because I would have to estimate those now anyway.
Right.
And no matter who you go through, those are the same. That doesn't change. So if you were to buy down 2 points, so at that you would spend loan amount's 285. I probably should have done a $3,000 loan amount. So what's that? 5,700, give or take, $5,700. Your interest rate would be 5.75. Actually worked out pretty well. 5.75, and your principal and interest payment and mortgage insurance would drop to 1748.
So 1882 to 17.
So call it $150, give or take.
$150 per month for 2 points. Which is $5,700.
$5,700.
So you're saving.
Right.
That's good.
So actually, if I do quick math here,
yeah.
So 5,700.
Quick or slow? I'm not going anywhere.
So that your break even is about 38 payments on that
until you can get that money back.
Till you are now making you've
got that money back that you put in originally.
Correct. So if you were to put another $5,700 down on that loan. I should have wrote that down.
Yep.
Your payment would change. I believe it was $14
per month. So $5,700 to pay points down, $130 a month.
Yes.
$5,700 towards your down payment
would be about $14 a month on that scenario.
Yeah, let's not put any more money down on the down payment.
Right.
If you've got 10 grand that you're like, hey, I want to put it down on a down payment. No.
Right.
Buy down the points.
Buy down the rate.
As much as you can, as low as you can.
Right.
Don't put it as a down payment.
Right.
If you got 30,000, okay, maybe you take 20 of that and put it as a down payment, but 10 of it should go towards buying down the rate.
Correct. Right. It's even more extreme in the $500,000 scenario. So that's our next one.
So now I want to just step back.
Yeah.
6.475, 5% down.
Yeah.
2 points would bring you down to 5.75 there.
So we're at about 3/4 of a point down on the rate.
So in order to get that same 130, then you're going to need what? If it's $14 at 5,700?
Yeah, you're going to need another
like 30 grand.
30 grand, 30 to 35 grand, somewhere in there
to get the same outcome.
Right. Correct.
5,700 or 40 grand.
Right.
Okay, got it. I think the answer is pretty clear
on what you should do.
I think the answer is clear.
Right.
But think about this. Have you heard anybody out there that's listening or have you heard this?
Right.
Has anybody talked about this?
Right.
Has your agent talked about this? This, if you want to reduce, if you're comfortable at that 1882, great.
100%.
But I can get you $140 a month savings if you do this. Does that work for you?
Right.
Because that works for a lot of people.
Right.
For a very limited amount of money.
Correct. Exactly.
In the grand scheme of things.
Right.
38 months payback is great.
That's less than I thought it would be, actually. Because I didn't even do that math beforehand. So next would be $500,000 purchase. So now we're kind of, talking Salem, Londonderry, Atkinson, for those of you that are listening in New Hampshire. That's New Hampshire. I still did 5% down just to try to keep it consistent because I didn't want to change the scenario because that'll change the buy down as well. So I wanted to keep that consistent. You're at 6.45, so nothing not much different than above. Your principal, interest, mortgage insurance payment would be 3130.
3,130. Yeah.
Yep. If you bought it down 2 points, which I did about 10K, but that would be 475 loan amount, so $9,500 would be really what it is. You same thing. You're at 575. So that doesn't change. The interest rate itself doesn't change. So you can see if you buy it down the same 2 points, the rate comes down the same in this scenario.
Yeah.
Your principal and interest payment in mortgage insurance would be $2,914.
$216 a month difference.
God, you did that. $216 a month different.
260 for how much? For 90
For $9,500.
$9,500.
Right.
Save $200 a month.
Right. Right. Versus, again, you put $9,500 down on that scenario, you're probably looking at, I didn't do this one out, but you're probably looking at about $40 a month. 40 to $45 a month different.
Yeah.
So $45. Actually, how did I do that before? So 216 was the difference in the payment.
Yeah.
So you'd probably need another similar, probably 40 grand to put down again on that.
So
again,
$9,700 to save 216, or not to save, but to get $216 a month, lower mortgage payment, or 40 grand, 45 grand,
give or take,
towards down payment.
Yeah, it's a no-brainer. Now, for those
Sign me up.
For those that are
Sign
listening,
me up.
now this is where it gets funny or interesting, because for those that are listening and they're like, "Well, why would I buy down points if everyone's saying that rates are going to fall in 12 months? I'm not going to hit that break-even point." Okay, cool. We got a great solution for you. Let's have the seller give you credit, and instead of just pocketing that money, let's go ahead and buy that interest rate down, because then it doesn't matter because it's the seller's money.
Right. So exactly, if you can get a seller concession towards closing costs, prepaids, escrows, use that money to buy it down.
Right.
Yeah, exactly. And those possibilities are out there.
Right.
It might not be the 1 week, 1 day, 3 day on market properties.
Right.
But okay, week 2, week 3.
Right.
You know what? Just give them a full price offer.
But ask
for the 2% back towards your closing costs. Use that to buy down $216 a month.
Right, on the rate.
Yeah, and the seller paid for it.
Right.
Thank you, seller.
And you were already okay with spending the money that you were going to spend to buy the house anyway.
Yep.
So let's just lower the monthly obligation on it for essentially free.
Yeah, not any of your money.
Right. So then you can refi in 12 months rates,
When and if.
Big if. But yes, if rates come down to, low 5s, high 4s again, you refi no problem. No guilt. You didn't spend any of your money you don't feel like obligated to get that money back.
Yep.
And then you can now take advantage of that now as well.
Yeah. Otherwise, you wait the 3 years and do it then. But yeah, if the seller can do it, if we can get seller concessions,
right.
Fan-frickin-tastic.
Yes, exactly. And it's happening in this market.
Yeah.
And there's other ways too, like I was kind of mentioning to you a little bit before this. You can do what's called a temporary buy down as well. It's an option. I will be honest, I don't recommend it very often.
Doesn't make sense to me.
It doesn't make a whole lot of sense, but lenders offer it. So where the sellers, you have to get a seller credit for it. You buy down, or the seller is essentially buying down your interest rate by 2% for the first year. So if par is 6.5%, you'd be at 4.5% for year 1. You'd make that payment.
Oh, so that's different from what I was understanding. So it would go from 6.5%. It would actually go down 2%.
2 physical percent. Correct.
So that makes a different story in my head.
Okay.
I wasn't picturing it as that.
Gotcha. Okay. Yeah.
So yeah, 6.5 to 4.5.
To 4.5.
That's about $700 a month because I just did something
like that. Right.
Just ran the numbers based on that for something else.
Right.
Yeah, it's like $700 a month.
Right. So you could buy it down. Well, the seller is essentially temporary buying down your interest rate down 2% for year 1, down 1% for year 2, and that's not based on current market, right? That's based on what you locked in at.
Okay.
So if rates continue to go up, your rate doesn't go up. You are locking in that buy down.
Yeah.
So that's important to note too. It's not adjustable. It's not like a 2-year arm or anything like that. It's set at the closing. Everything that you're signing, you acknowledge. So 4.5, 5.5, and then the third year, okay, we're at that 6.5. and it's a 30-year loan. So it's not
Yeah.
like the first 2 years mean nothing towards your amortization. You are paying down principal
Yeah.
in that time as well. You still have to qualify based off of the par rate.
Yeah. Yeah.
Just like a regular ARM, if you did like a 5-year ARM, you have to qualify actually more or at a higher rate in case it does adjust. So it's not like you can use it for buying power.
Sure.
It's more so for easing yourself into that monthly payment, especially for first-time home buyers. This is a huge deal for them.
Yep. Yeah, and a great strategy if you are expecting, hey, right now I've started this new job, but I know that in year 1, 2, 3, I'll be getting a promotion, or
Exactly.
maybe my significant other is going to start in the workforce,
Yep.
and they're going to actually make more money.
Yep.
Whatever the case may be. There.
The one career I've seen it a lot is nurses.
Hmm.
Because you start off, you're just coming out of school, or you're just finishing everything. You're kind of just starting out, or you're in residency now,
Yep.
and in 2 years you're going to be an RN or an LNA
And
or
you'll be-
something
your
like that.
income will go up
You
significantly.
know your income's going up. It's not like you have to guess and earn. You earn the promotion, right? But it's the typical ladder you're climbing up. It's not like you're junior level accountant and you're hoping in 2 years now you're the VP of finance. Like that doesn't make sense.
Yeah.
Right. But it's a very strategical climb, and it's very predictable. Okay, cool. Yeah, let's do that because I know my income's going up. So
Yeah.
I know I can afford that.
These are all great tools in the toolbox for to have very frank conversations with your lender and your agent on what's going to work best for you and your money. Again, money matters, right? Like, so how are you going to use the tool of money to help yourself either buy a home,
Yeah.
invest in real estate,
Yep.
whatever you're going to use that for,
Right.
Whole life insurance and infinite banking, whatever it is. Yeah.
Right. However it is. I don't think this is a topic that's talked about enough. I think everyone sees it as a waste to buy down points. Some scenarios it is.
Sure.
100%. Fully on board
Plan
with
to
you.
move in a year or two. Yeah.
Right. You don't want to spend that money, right? It's not going to make sense in the long term. But if you know this is your house and you're comfortable with the rates don't seem like they're going to go anywhere, right? And you're good with it.
What have you heard?
About rates? I think it was the projection that we saw was Q3 of 2023 is when they're going to start to dip down.
But what are they going to peak at?
We haven't heard anything about that, which is scary because that means that it's probably going higher.
Yeah.
Not probably. It is going
it's
higher.
definitely going higher.
We originally, it was supposed to be 5.75, and now we're at 6.5. So it wouldn't shock me if we touched 7 over the winter, and it wouldn't shock me if next spring they kept it there to see how the market reacted to it, and then possibly start bringing down. But for all I know, they could touch 8, they could touch 9. On the flip side, they could also go down to 5 if there's an actual recession that they finally declare that we are in.
Sure.
Right? So like it's all depends. Like they can kind of manipulate this a little bit how they
that's
want to.
Exactly what they're doing, right? To create the recession, to then create the interest rates to come back down.
Right.
So getting it all under control, they need to create a recession.
Right. They almost It's unfortunate, but they do. They have to.
I've been hearing 200 basis points, so 2%.
Like an increase of 200 bips.
So like to 8%.
Yeah, that's pretty much it. Yeah. 6.5. Yeah, so 7.5, give or take. 7.25 on conventional stuff, depending on credit. Again, if your credit's good, if your credit's below 720, if it's below 700, you're sevens.
Yeah. Which is
all day long right now.
Which isn't necessarily like, it's higher than it has been, but it's not like higher than like it's ever been in historical
right.
The eyes of the history.
And it's funny because I used to get frustrated at that statement because I was like, well, house prices were cheaper, but then people's income was also lower.
Yep.
And
a lot lower.
I've done a lot of math on it because I'm always curious myself. And yes, houses are harder to afford now than back then, say 40 years ago, but it's not to the scale that it's impossible. It's just not.
It was more expensive in the 80s
when it was 18%.
18%.
100%. Yep.
And people weren't making anywhere near
what they're making.
Yeah,
right
like the affordability index. Like that was harder in the 80s than it is right now. It's still the affordability is the second worst behind the 80s than it's ever been. But it's still not as bad as it could be.
Right.
But luckily, or unluckily, people have been getting raises. But, if recession happens, those people.
And that's where investors should take note, right? And any savvy investor understands that when recessions happen is when your money is made. That's
Yeah.
you scoop up properties at that point, and you're willing to hold, and maybe not even that long, 2 to 5 years sometimes.
Yeah.
And now all of a sudden you have a portfolio of say $1 million of real estate in 2023, and then in 2028 it's $1.6 million, $1.7 million.
The best hedge against inflation is real estate,
right? Right.
It's going to keep rising, no matter what the market's doing, and at least your money's in something that is performing.
Correct. Yeah. And like we said, you have access to it.
Yeah.
You don't have to wait until you're 62 or 59
in an IRA
now.
Yeah, whatever it will
and it's
be.
not that, it's not that that's a bad tool. It's just
Another
recognizing you have to wait until you're at a retirement age before you can touch your money.
Right.
Right. And if you're good with that, awesome.
Yep.
Like hammer it.
It should be just another tool in your toolbox, right? If you've got the disposable income to max that out, great. But you should also consider some other avenues as well.
Right.
If you can scale back on some of that, and I wouldn't necessarily, now that things are down, I wouldn't scale back on that, but maybe even double down.
Right.
While things are on sale.
The stock market's actually kind of on sale right now. It's probably not a bad idea.
No, because it's on sale. So go shopping.
Yeah, exactly. That's great. And I think that's important to note too, right? We talk a lot about real estate, and like we mentioned at the beginning, we want to give all the options for it.
Yep.
And there's no right or wrong way, right? It's just the way that you pursue, and that's just kind of what I want to put out there. I think.
A lot of it's a comfort level.
Yeah. I think it's just a lot of people listen to real estate podcasts and they get the vibe of, I only can do real estate to get rich. It's like, nope, it's not true, right? It's a proven avenue, 100%, but recognize there are other outlets, right? There's a lot of people that do get rich off of their IRAs, right? They hammer them. They're good with taking it out. Awesome, millionaires, perfect. But then there's also a lot of people that do whole life. There's a lot of people that invest in real estate. There's a lot of people that do wholesale, it's real estate.
Think about the richest people though.
Yeah, 100%.
Are they like, oh, my 401k got me here? No, no, real estate got them there,
right?
And no matter what you think about them, again, we all know him, Donald Trump. He's got a portfolio.
Right. And a rather large and rather luxurious portfolio.
Yeah, and he does all sorts of things. He's in all of those stuff. And again, no matter what you think about the guy, that's just one piece. Think about the people that you hear about, where are they getting their wealth? Yeah, it's not sitting back saying, my 401k did this for me.
Right.
Here I am.
Right. Even corporations you see start doing it now. For instance, I think the big one that a lot of people, if you're on Instagram or TikTok, have probably heard of is McDonald's. McDonald's is a real estate company.
They're the biggest. They've owned the best real estate in the country.
Right. And people don't realize that.
Every corner.
They don't care what they make on the food because they own the land.
The real estate.
What does it matter?
It's more valuable.
Right.
Yeah. Exactly, because if they close down tomorrow, that is prime real estate.
Yeah, exactly. But I think this was important to talk about. That you don't always have to waste your money on your down payment, right? And I don't want to say waste the money on the down payment because okay, cool, you're in less debt for some people, right? That's very important to them.
Yep.
But if you're looking at monthly obligation and what you're willing to spend anyway at the beginning, right? Why not look at these different avenues to get your monthly payment down 100, 200, 300, depending on your loan amount. It could be $400 or $500 a month if you're looking at, jumbo loans, which in, again, Salem, Londonderry, Atkinson, Amherst, Merrimack, these are not, that's not uncommon to have somebody at an $800,000-$900,000 loan anymore, which is crazy to think about, but 3/4 of a point on a $900,000 loan.
A couple $100.
Probably $400 or $500.
Yeah.
Anyone like that, why would you not do that?
Yeah, exactly.
So, but yes, next week we will have Mark, what's his last name?
Mark Bashir.
Bashir, yep.
Just how I started this podcast.
Yes. Yes.
Mark Bashir's Top Wealth Agenda.
Yep.
Bank on Yourself Advisor.
Yep.
Some whole life topics. I am still skeptical on this premise. I want him to tell me and show me otherwise.
Yep.
why it works. I actually have a call with him today at 3:30 to run scenarios for myself personally, and I'd love to potentially bring those to that our podcast next week and our discussion next week. So it should be good. And then the week after that, we'll have Matt Hawkins, the lumberjack landlord, talking about 4-3-2-1 and reverse offer strategy. What the heck does that mean?
We're going to find out.
Stay tuned.
Stay tuned to find out. Yeah, we're getting guests on. We're going to keep lining these things up, just getting different perspectives in all different avenues. I love it because I learned so much about it, right? And it's just cool to learn how other people are building wealth other than just the typical stuff that we've been talking about. So I'm stoked for it. I'm super excited.
I think this is great. Money matters. It's what it's all about. Real estate, lending.
And everything in between.
Exactly.
And that, Rich, is why money matters.